All right, people, welcome to this episode of the Vision2Mission podcast. Today, we have a mortgage roundtable. Classes in session. We have some experts, some hand-picked experts from around the country, joining us. We have Mr. Zachary Wain of Wain Capital joining us from Arizona. Welcome, Zach. How you doing this morning?
Doing great. Appreciate it.
This afternoon on the East Coast. Absolutely. And we have Mr. Shead of Movement Mortgage, and Movement Mortgage is definitely making moves. So we will talk about that as we go through the podcast. Welcome, Chris. How are you?
Oh, doing great, Brandon. Thank you for having me.
Absolutely. No, again, thank you guys for being on the podcast. So there's been a lot of changes this year. There's been a lot of, no pun intended, moving parts, but there's a lot going on and we have a lot to discuss. So we're going to kind of go to the broadest topic, right? Probably since I would probably say maybe February of this year on up to the present, we've seen a steady increase in mortgage interest rates, right? This for a variety of reasons, but primarily it's because of the Federal Reserve raising the federal funds rate because of inflation. And I wanted to see, being in different parts of the country, having different perspectives, what are your thoughts on the effect on buyers, over a period of time, not just now in December as we end off the year, but what have you seen as the effect on buyers and the effect on the industry over the past several months? And I'll go ahead and start with you, Chris, on this one.
That's a great question. I think a lot of what we saw, certainly early on in the year when the Fed kind of said, all right, quantitative easing is we're going to stop that. Well, The amount of time that they allowed that to go saw a pretty volatile response as inflation had really gone up. And inflation typically, mortgage rates typically follow that inflation trajectory. But for that early on period, inflation was rising, rates maintaining a certain low level. And then once they took the governor off, it sort of had a very volatile reaction. And so that's where we saw a lot of interest rates jumping up very quickly. And then I think a lot of people got, quite frankly, scared. I mean, my goodness, when we started to see movement like that, I'm sure reminders of 2008 came around for a lot of people without having the knowledge of kind of what the differences are and the analytics that show what those differences are. They just go back to that last pain point. So I think a lot of people reacted in a very emotional way. There was probably two sides to that. Some that were going to say, oh my gosh, all right, if rates are jumping, I'm going to wait for house prices to come back down. The others, I think, were trying to rush to actually get an interest rate as it was going up because they thought it was going to go up higher. And so the overarching, and I'm not sure, Zach, if you see this on your side there, but the inventory levels have been a big time issue. So we saw a lot of competition, a lot of over list prices that were being purchased. And then as a combination, trying to capitalize on what the rates were doing at that given time. So a little bit of what we're seeing here on our end.
No, absolutely. And what are your thoughts, Zach?
It's definitely been a wild ride. One of the biggest shifts in consumer sentiment in a short period of time. Everyone in the world wanted to buy a home during, 2019, 2020, and 2021, best investment ever. We all know how that went. Low rates propelled everything. I thought it was interesting. I was kind of surprised, and this is something that I continue to learn, just consumer sentiment wise, that as interest rates start creeping up and we're in Q1, they're moving up, Q2, they're really ramping at a very intense pace. I had to remind myself, and I still am, that the average consumer doesn't know what rates are every single day. And it usually takes months and months for the average person to know, oh, interest rates are at 5, they're at 6, they're at 7. Someone who's home buying who's actively trying to buy and is getting updates, it's different. But we were seeing a decent amount of demand in Q2, even when rates were 5, 6%. And, the consumer wasn't too worried at that time. And then Q3 hits, and now we're talking 6, 7% rates. And the consumer had a lot of time to just digest what was going on. We definitely saw a big pullback in consumer sentiment, demand. Just as you said, we'll wait since rates are high till next year and housing comes down. That seems to be the standard message from a lot of people. I think it's going to be interesting on the flip side as interest rates come down, which they are starting to now. The consumer doesn't really know that either. And that may take months and months for that to flow through the national sentiment on, oh, rates are at 6, they're at 5, they're at 4, in the future, and how long that'll take to shift. So it's consumer sentiment's an interesting thing, but definitely it's been a wild ride, fast pace on rates. And, it's a lot of interesting effects on people, whether it's someone looking to buy immediately or the person who got in a new build contract and they can't close for a year and they were talking 275 and now they're at 7. Oh my God, what that does to their psyche. A lot of interesting impacts for sure.
No, absolutely. You just mentioned, I have a guy that I'm helping right now with new construction. It's closing in January, but he went under contract in July.
Yeah.
I mean, and the rates are so much, they're coming down slightly, but it's so much different. And I'm just grateful that, this doesn't affect someone like him qualifying, because that could kill the whole deal.
Yep, for sure.
Or it could really make you have to switch the type of loan you're going to do, get a cosigner, all types of things that you don't necessarily want to do, at that particular time. And so as rates had gone up, I think there was definitely a major shift in consumer sentiment. But let me just ask you this, being there in Arizona, have you seen a large shift in terms of the population, people coming from California? For example, I listen to a lot of podcasts, I read different things. And over the past year and a half, 2 years, primarily because of COVID, I think primarily because of the taxes there, but now because of affordability primarily, in California, have you seen that wave of people coming into the state, coming into Scottsdale, or what has that been?
So for a long, long time, we've always had that people move from California because it's expensive and come to Arizona or other states. And you see that and you feel it, but it wasn't really until COVID happened, and it was just blatant. And you saw it, you felt it, the amount of clients that we had from Washington, from California, whether they were investors or literally moving because they wanted to get out of that intense lockdown, which, no one knew what they were doing, but Arizona was a very open state and some other states weren't. So people were coming here for that reason. And also for, prices, everyone could work from home. People were making higher wages there. They could work from home here and buy more homes. So it was noticeable. So that was just more fuel to our fire in our market. The influx, the actual population growth was massive and you could feel it. Now in this moment, I'm not really seeing or feeling migrations. I don't have the data on, what's happening right now. We are still growing. But for a year or two, for about 2 years, I mean, it was, you'd feel it across the board, whether you were in the business, an average person, like our neighbor moved from Washington and bought a home for all these reasons. So it was very palpable for a couple of years, for sure.
No, absolutely. And so, Chris, being on the East Coast, and here kind of being here in Virginia, what has your perspective been? I don't think we've had a large migration into Virginia. Oh, did I lose somebody? Oh, thank you, Anton. He brought up an article here. So what are your thoughts, Chris, in terms of what you've seen in terms of the migration from different states?
Well, I think based off of where we are, we constantly are in a very transient area with federal government in the backyard, administrations changing, military installations, so there's always this sort of revolving door around Washington, D.C. But more so, we're starting to see, obviously, non-government employers come into the area. We had Amazon come in just before the pandemic. And immediately what we saw was the number of homes that were on the market kind of, sorry, guys. My light went off here in my office. There we go. So what we saw was that the number of homes that were on the market, as soon as Amazon made their announcement, it shrunk. And those who were interested in buying were thinking, okay, well, maybe I'll hang on to this for a year or two, let Amazon do its thing, bring prices up. And then COVID hits. And then we've been in an inventory shortage ever since. So I think that is very conducive to insulation of home value in our area. And we know that real estate will always follow jobs. And when we have the nation's largest employer here in our backyard, there's going to be that insulation. I found out over the weekend, someone was saying that we actually here in our area live in a false economy. And I was like, that's an interesting way of putting it. Right. I don't know if I like the false economy, but there is some insulation certainly that sort of stabilizes our area. But inventory certainly has been an issue that we've seen, Brandon.
No, I absolutely agree with you. I used to live in New Jersey for several years before moving back down to this area. And I just remember kind of Zach had alluded to like that 2008-9 type of deal, and it hit hard up there. But this area really does seem like it's in a bubble of sorts, right? Because of the military, because of government, because of contractors, because it's the nation's capital. Now I don't think it's completely immune, right? Not with a play on words, but we haven't seen it as much. However, one thing that I have seen, and I know that you both have noticed as well, one of the biggest shocks of the year was several months ago when Loan Depot Wholesale had announced that they were closing their wholesale division. That was crazy because I'd done so much business with them, and kind of looking at the reason why they had done it, because of previous quarters, they had lost hundreds of millions of dollars, literally. And after them, now it was more of a domino effect. And not only that, Remax had laid off about like 17% of its workforce, reduction in force. We had Redfin doing the same thing. We had all these different mortgage companies with massive amounts of layoffs. So I wanted to get your both of your thoughts on that, because coupled with that, do you believe is it just the market by itself, or from a management perspective, did a lot of these companies just simply overhire? Did they just hire too much over the past couple of years? So I'll let you start off with that, Chris, and then we'll go over to Zach.
Sure. I think certainly there was a need for the overhiring when there was the refinances that were coming in droves. I mean, it was a tsunami of those who were trying to take advantage of those 2 and 3% rates. So companies had to staff up to basically support the need and to be able to close all of these transactions in a relatively timely manner. So I do believe that during that time it was needed, but when refinances started to go, interest rates started to come up, yet these institutions that had staffed up for that purpose knew that there was going to have to be a letting go of a number of team members and employees. So that's what I would say as far as the staffing concerns, and why I think there's been huge hirings, and quite honestly, mortgage companies were paying a lot of money. I mean, you could almost set your price. I mean, what do you underwriters could set their income to come work and help us, and so. But when that time ended, I think the writing was on the wall that there would be significant layoffs across the board. And with respect to Redfin, or typically, I think it was more of these iBuyer type programs that Zillow certainly felt its pain point, that they thought it was easy to do, quite honestly, what we do, and to basically corner a market that they weren't prepared for. And so there were massive losses that happened. I know I'm talking with an agent right now who was one of those who were let go from the Redfin iBuyer team. And it was just very interesting to hear his perspective. But long and short, I think they got in a little over their head. It wasn't a model that was sustainable for them. And obviously the numbers certainly showed that they had to make the decisions they made.
No, absolutely. Go ahead, Zach.
Yeah, I was thinking about this question probably more than most, and I was trying to figure out a rational way to say that we shouldn't have overhired so much as an industry, but I don't think there's any rational way to say that we shouldn't have done it. I mean, there's not many times where the demand for your product goes 5-10x in a matter of a month or two.
Exactly.
And if companies did it from the big to the small, to me, I'm a small shop, to massive companies, if they didn't overhire, I mean, consumers would be sitting on hold for 4 hours. Their loans would take 4 months to get done. They'd be pissed. Everyone would be upset. It would have been a nightmare. And so the only real option is to staff up. And I was trying to think of other ways to avoid it, raise your rates and get less volume, but then you're treating the consumer poorly, and that doesn't make sense either. So I think it was necessary. I think there was no way around it. And a lot of companies did staff up and still couldn't handle the volume. And it still wasn't enough for them. So, some companies did it better than others, I'm sure. Like how Loan Depot lost money. I don't understand how that works on their end and how they mismanaged that, but I'm sure it wasn't easy to do. But the unfortunate part of that is you have this massive demand, this massive workforce that has to be trimmed. And I think we've seen that across multiple companies, big, small, everything. It's unfortunate, but I don't think there's many times in many industries where demand for your product goes through the roof in that fashion.
No, I would agree. Yeah, it's an anomaly, I think, for sure. And I think for people who've been in the industry for a while, the way that it happened, right? But it's not just because of the housing market. It's what happened globally that ended up affecting the housing market and the economy. And so you mentioned Loan Depot. Loan Depot has, had a retail side and a wholesale side, right? Dealing with brokers and then dealing directly with consumers. And so that kind of leads me to Chris and Movement Mortgage, because from my understanding, it's retail, it's direct to consumer. Is that correct, Chris?
Correct.
Right. Now, from the articles that I've been reading, Movement Mortgage is expanding, right? Casey and the management team have eyed certain markets in certain areas. So share with us, what's Movement Mortgage doing differently, right? It's allowing it to grow and expand when so much other contraction is taking place.
I would say a big portion. So Movement throughout recently has created their own servicing portfolio.
Okay.
Which was a big change and a big shift for us. But we also knew during the pandemic that it was an artificially inflated market. It had to have its end. Certainly when we started to see inflation really jump, quite honestly, I was amazed at how long it actually went. I thought it would end a little sooner, quite frankly. But we were preparing for it the entire time because we knew that through these moments, there's going to be companies that just don't make it. And so it was a different philosophy of really trying to stack cash for the opportunity, for the buying opportunity. And Movement has acquired and done some smaller acquisitions on the East Coast. They a couple of years back took over some West Coast smaller shops, but their goal is to continue to grow, continue to support the vision of Movement of building charter schools all across the country, and it has a much bigger vision than just kind of doing as many loans as we possibly can. It's a means to an end for a larger purpose, which is one of the reasons why I'm here. I love what they stand for.
No, and I appreciate that because within business, sometimes you have a certain amount of altruism, right? Like you said, it's a means to an end. How are we going to get revenue? How are we going to grow our brand so that we can perpetuate or we can get our principles and our character and our mission out there to be able to help people? So I really respect what's going on over there with regards to that on the retail side. And it's interesting because, Zach and I do a lot of business with United Wholesale Mortgage. And so, and being brokers, in a sense, we're all brokers, right? Because if you're in between A and B, you're a broker, right? It's funny. I did a video a while ago, and I said that, mortgage brokers and realtors were actually related, because we are in between a buyer and a seller. And that's what it is. You broker, you negotiate, you administer, right, a transaction. And so that's what we do, right? And so that's just kind of the way that I see it, personally. But I think that especially in this economy, consumers need to have a certain level of trust and education like you all provide. Because, right, you're right, Zach. They don't know what's predominantly going on in the market with regards to rates. They don't know how that's going to directly affect them in terms of what their monthly payment is or their budget until we tell them. Like the average person doesn't work with a mortgage calculator and amortization, right? And this and that and the other, the way that we do, so that we can help them, to connect. So let me ask you this, Zach, being a mortgage broker, how is your company and you as the owner of the company, how have you handled the current market and all of the changes and everything that have been taking place so far?
So you got it.
He's going to edit this part, so don't worry about it, guys.
How's that? Better? Okay.
All right. We are back. Go ahead, Zach.
Well, I was just going to say, in response to your question, it seems like the majority of our calls, our clients now are, for the most part, primary home purchases. Someone wants a home for their family. A lot of the investors, which is super, popular. Everyone's buying homes. Everyone, investor was super heavy the past couple of years. There's still some, but that's come down a little bit. So a lot of the advice that we're giving is more focused towards people buying their first home. A lot of first-time home buyers is the current client base. And, for my role, I like to consider myself a mortgage advisor, just like a financial advisor is there for someone's stock and equities and retirement planning. I'm here to figure out, not figure out what's best for you, but give you options, advice. And sometimes it's calming down fear of the current market. Sometimes it's taking people down, like, okay, let's also calm down with how excited they are to buy. But the past 3 to 6 months or so, there's been a lot of fear for your average homeowner. Should I buy now? Is the market going to collapse? Is this 2008? Oh my God. And without knowing the future, but talking with people specifically in my market, the Phoenix market, every market's going to be different. But a lot of the recent talk has been demand is very low right now. There's not a lot of buyers. Inventory is actually still fairly low in Phoenix. So we haven't hit this glut of inventory and no buyers. It's still fairly low inventory, but just not many buyers. But home prices have corrected a lot here very sharply, like in many areas. But in talking with different agents, different people in our local market, springtime is home buying season in most areas. And specifically in Phoenix, springtime is gorgeous. And it comes off of our winter, which is gorgeous. We have snowbirds, people from Canada, people from the East Coast. We have the Super Bowl. We have the Open. We're going to have a lot of people here who realize, oh, it's 65 degrees in January. Maybe I should buy a home here. So there's always an extra push in our springtime for buying season. So some of the advice I've been giving is just things to think about is almost every home buyer is scared right now to buy. Sellers who are motivated are discounting heavily, and you're probably going to get a better deal today, January, February, than you will in April, May, when home buyers, and it won't be this, 2020 glut of everyone and their brothers buying a new home, but there's most likely going to be a big uptick in demand. More buyers will come out, especially as most people forecast rates will be a little bit lower than they are today, probably. So it's calming down some fears. It's trying to, hey, here's my thoughts. Talk to your realtor, talk to other people in your circle and see what they think. But if everyone's scared to buy now, you'll probably get a better deal now on actual home price. You marry the home price that you get. You pay $500K, you paid $500K, done. As opposed to maybe in springtime, maybe that'll creep up a little bit when there's more buyers. Maybe you won't be able to negotiate concessions and temporary buy downs and all these things. So it's been a lot of just take a moment and think if now's the right time to buy for you and your family. It's probably a better time than it was 6 months ago. I'd rather buy a home today than 6 months ago.
I'd agree.
Rate may be a touch higher, but I'd much rather be able to refi in 6, 12 months and get into a better deal. So a lot of it is calming down fears, never pushing anyone in any direction, but also sometimes it's a reality check. People get fearful, and rightfully so, but then you have to think of the flip side. If everyone's fearful, then no one's buying, and maybe you can get a really good deal. And if everyone's thinking the way you are, there may be a rush of buyers come springtime as opposed to now. So that's been the common theme the past couple of months on just at least telling that story and seeing what people think.
Oh, absolutely. Go ahead, Chris.
Oh, I couldn't have said it any better, Zach. It's what I'm talking with a number of borrowers about right now. In our area, we were seeing, and Brand, I know you can attest, is 30, 40, 50,000 over list price. And yeah, that's great that they got their 3 or 4% interest rate, but I would argue the other side is probably better. Negotiate, even though it's a bit higher, you're getting some seller concession, you're getting that 2-1 buy down, and then you refinance when the time is right into a market where, the other part that we have to talk about, guys, is the 2 or 3% interest rate environment was never a healthy environment. A pandemic had to occur for that environment to show itself. And so when we put that in perspective, a normal, solid real estate market is this 4 to 5% range. It makes the decision a little bit more palatable, and you just kind of prepare and educate, as Zach and Brandon, you've said, that that's all that's needed. It's addressing the fears, but it's also giving them analytics, and it's also painting the picture, showing the charts, knowing that the charts are in essence telling us a story. And with that, it kind of reduces a lot of that fear and anxiety. So, Zach, I couldn't have said it better.
And I appreciate that. And, as we were talking about off camera, so I was looking at, Brian Buffini, like every year he does what's called his bold predictions at the end of the year. And so he had the chief economist for the National Association of Realtors, Lawrence Yun, on. And so a couple of things they were talking about was actually their prediction, right? Or Brian's prediction more was rates are going to be more in that 5 to 6 range, maybe, throughout the year at some point. But he also made the same point that you did, Chris, meaning that there's not going to be this mad rush to purchase homes. It's going to be, the prices are going to be more stable and it's going to be more normal, right? There's going to be a normalization of how long houses are on the market.
We would all love to see that.
Yeah, like absolutely. And the thing is that, I think from our end, right, it benefits us more with regards to the buyers. So I wanted to get your thoughts on a few things that they predicted. One is they predicted that there would be at least 200,000 less realtors by the end of next year. Okay. Another prediction is that they're going to be a lot less mortgage loan originators, in the field. They're going to be a lot of LOs that are going to drop out. And they're going to be more contract cancellations for a variety of reasons. So what do you all think about those particular predictions? You think they're accurate, kind of in the ballpark?
Well, I don't know what the starting point was for the total number of realtors, but what I could certainly say is it happens whenever there is a tightening. Mm-hmm. We know that the market has contracted across the board on the lending side around 66%. And for those, specifically the LOs, well, I'd be curious to know how many LOs came into the market when the refi boom was going, and they really don't know how to talk to a realtor. So it would be an interesting thing to look at, but I absolutely believe that there's going to be triage, and certainly going into next year, we're going to have some recessionary pressure for sure, but real estate and mortgage rates typically do very well during recessionary times. If you go back and kind of look at the charts, other than the housing caused recession of 2008, all other recessions, we've actually seen rates come down and home value go up. So, but it wouldn't surprise me, Brandon. I mean, that certainly sounds like it should be in the range. And quite honestly, I think that's a good thing for our markets, getting the true professionals that stay and are really invested in the communities and the clients that they serve. So,
no, absolutely. Go ahead, Zach.
And Chris, I think you hit the nail on the head, and I think we have to remind people of this more than we think, because we see charts, we look at this stuff, and maybe we know it fairly well, but most people don't. During almost every recession, home prices typically do very well. Mortgage rates typically come down. It's usually a good time to buy a home if it fits your financial picture. Just everyone's a little scarred from 2008, which was housing caused recession, a little bit different. So for those predictions, I'm kind of curious about the cancellation one. Is that because layoffs, people lose their job, there's changing of factors going on, or just antsy home buyers? I'm not sure about the fallout of contracts. Well,
what he said was that he feels that there's going to be a clash in terms of buyers not wanting to give certain concessions on their end, meaning home sellers typically feel my house is worth this, right? Yep. And you said the word kind of real pro, Chris, because he said, well, the real professional realtors, the real pros are going to come in and let them know, no, your house is not worth this, right? Okay. It's worth that. And this is the reason why, and give them the proper education and guidance with regards to that. So that's the reason why he said that, he thinks there's going to be a higher amount of cancellations. Simply because there's going to be that fundamental disagreement.
And that's a fair point, I think, because everyone's used to my home's worth $2 million now, when, maybe it's going to be down here, and it may take a long time for people to realize that. So that's a fair point. I think on the realtor and LO side, this may be tough to track, but I think the full-time realtor, full-time LO absolutely is going to come down. Right. I feel like there's still, I'm sure you guys see this, everyone's a realtor. Everyone got their license. There's a ton of part-time LOs who, have a side hustle and do some other. So the actual full-time professionals, yeah, for sure. I agree. It's going to be a thinning of the herd. Yeah, most definitely.
Yeah. And I can see that happening. And I think that one of the things that coming into this year and in the beginning of the year, we did training with my company, and we just had meetings saying, look, there's going to be attrition. It's going to happen because there's going to be less business out there. And if you're not sharp, if you're not building and maintaining your relationships, right? If you're not being creative, if you're not going to get business in different areas, and if you're not dedicated, right? Like determined, then you're going to end up falling off, going into some other field, whatever. And that has happened for sure. And I can honestly say, like, I wasn't as worried with regards to like interest rates and everything. Was I concerned from a business perspective? Yes. I'm like, okay, but I wasn't worried because I saw it more of, okay, we have to stay the course. And we know that people are going to fall on the left and the right. So I'm looking at it as, well, we can potentially increase market share. Now, has that really happened? Not necessarily. We have stayed the course, but our production has been a lot lower, but we've stayed the course, and we've been able to build new relationships, because it's really about being able to see beyond that, being able to see into the next year. So kind of speaking of that a little bit, we're pretty much at the end of the year. We're heading into next year. Zach, you had alluded to the fact that, which I agree with you 100%, like real estate, no matter where you are in the country, it's cyclical, right? It's seasonal for a variety of different reasons. So, what are your thoughts specifically? I think the Fed has a meeting coming up, right? Is it like today?
Tomorrow's announcement, yeah.
Right. So, there may not be as big of an increase, but there probably would be an increase. So what are your thoughts coming into on this end, on the East Coast? It's the winter. We got 3 good months of winter.
Yeah.
It's like it's in the 40s outside. Zach, come on over and join us.
Come out here play golf, man. It's nice.
But what are your thoughts? I mean, do you think that what do you think is going to have the advantage? What's going to have the upper hand with regards to is it the season that's going to have the upper hand, or people are going to be more focused on still the interest rates being high? What are your thoughts on that? Zach, I'll let you start and we'll go over to Chris.
Okay. I think there's going to be a few factors that all kind of parlay into spring being better than maybe the average person thinks, or maybe some analysts do. First, to back it up, I'd like to say we all felt this and saw this, but a year ago, almost every mortgage analyst was wrong, economist was wrong about where rates would be. Mm-hmm. Right? Like, we'll go to 4.5%, 5%. No one thought inflation would rip the way it would, and the Fed would be so aggressive, which it had to be.
Right.
So any forecast is just, doing our best to make some guesstimates and painting them as such, right? Not like this is what's going to happen. But I personally think, one, just from the people I talk to, we're in 5 states. Majority of our clients are in Arizona or California, but majority is Arizona. And again, the sentiment has been, I'm going to wait till next year and for rates to come down. I'm going to wait for next year and the rates to come down for 3, 4, 5 months. Next year, rates to come down. I think one thing is it's just the end of a calendar year. That's just a mental, like, all right, this has been a rough year for our home buying thoughts and we can't get what we want anymore and we're upset. A new year starts, kind of a refresher for all of us. Springtime in general, yes, is buying season here. I think that'll ramp things up. But I also am a believer that mortgage rates are going to come down and inflation is going to come down, especially CPI numbers are going to come down much faster than a lot of people realize or think, for 1 or 2 specific reasons. How quickly, tough to say. Where will they end? I don't know, but I think it's within reason by Q2 or Q3 next year, rates are substantially lower than they are today. Not 3%. That's not happening, I don't think, at all, right?
No.
But I mean, for a while, a few months ago, there was a week or 2 where we were quoting 4.99 on products when we saw a nice dip. I think we're going to have a lot more in the high 4s than a lot of people think, a little quicker than people think. And it'll take the consumer a minute to feel rates are lower. But I do think home prices in our market and a lot of markets are going to stabilize come spring. And maybe like you were saying before, there will be this clash of buyer versus seller demands, but maybe that's a good thing. Mm-hmm. And maybe that's a little bit longer basis in some markets, and rates come down a little bit so more people can get back in the game, but nothing so ridiculous that we add fuel to the fire.
No, I would agree.
Yeah.
So go ahead. Got it. So go ahead, Chris. So
expectations for next year, Zach, I agree. I think that Q2 is a good benchmark for, potentially seeing that high 4%, low 5% rate environment, maybe even into the mid 4s. As far as competition, as far as buyer activity, I think in our area, I'm fully expecting that once it sort of cycles through, we've talked about this a number of times, that it takes a little bit more time for the masses to get the news that rates are coming down. I think there's a lot of people on the sidelines that are waiting and are ready because we haven't talked about this, but rentals are going up. The rental values are going up, and they're going up yearly. So there are people that are ready to chop the bit and buy a house. And what I think could potentially happen, at least in our area, and why I'm so proactive in letting people know, hey guys, now would be the great time to buy, knowing that you're going to hold this mortgage for no longer than 2 years. But I mean, and I think that's a long runway, but basically secure the home, secure the asset, get some concessions, get it for less than list price before the competition comes back. Because I don't see our inventory just exploding out of nowhere. And I think that the buyer traffic, once it gets back into this 5% range, that it's going to pick up quite a bit.
No, absolutely. I think, I was listening to a podcast a while ago with Grant Cardone, and he was talking about how he just doesn't believe in like owning, like he owns a bunch of properties, but for himself. I'm like, you've got to be out of your mind. And I mean, because I can think of all of the benefits of owning versus renting, right? There are a lot, and we can kind of talk about it if there's a disagreement. But, I'm sure you all have done this, but I've done many times with people. I'm like, how much are you paying in rent? $2,300. Well, then that's okay. And so how much money do you have as a down payment? Maybe you have some, maybe you don't have a lot, but then we equate it to what they can purchase in terms of a home. And then we lay out all of the benefits of home ownership. Furthermore, there are times when people will say, well, I don't have a lot of money. Well, if your lease is ending soon and you're going to an apartment, you got to put down your first month's rent. You got to put down a deposit, like those things you could. And back when there was a more normal market, we might be able to negotiate some seller credit toward closing costs. And there's a lot more flexibility and possibility, with regards to getting someone in a home and persuading them, not pushing them, but persuading them into understanding this is part of the quote American dream. This is part of what helps you to build wealth, right? Yeah. To build equity, because people don't have a very clear understanding of what equity is, right? And so I think that the rental increase is absolutely, Chris. I know that in this area, it's been I think it's like probably a 10%, 15% year over year increase with regards, to the average rental rates. But in my opinion, I think people need to have the right expectations, meaning there are the statistics out there that say, well, a year or two ago, to afford a home, you needed to have a household income of this. Let's call it 60,000, 65. But now that's increased dramatically to like 90 or 95,000. And so I want to get your thoughts on that. How that's affected people. But in addition, my personal opinion is that I think if people and they want to own a home and that's their goal, they need to temper their expectations then, right? Because you're not going to get a $650,000 single family house. You're going to get something a lot less, but maybe you still want to be in a desirable area with good schools for your kids, with a good, commute, but people can still own. I think they just have to set the right expectations. So I'll kind of get your thoughts on that first, Zach, and then we'll go over to Chris.
Yeah, I mean, I think that's the biggest slam dunk topic we have. Building equity year over year, decade after decade is how you build wealth. I mean, look at the average American's 401k balance. People don't save enough to retire. They don't save enough in their savings account. Building equity and home appreciation is probably the biggest tool available to people. And it's one of the easiest ones too. Save 3%, save 3.5%. I know it's not easy for everyone, but it's attainable. And everyone the past year, and we'll talk about it more, I'm sure, inflation's the biggest thing. For everyone. If you never buy, you will never fix your payment. You'll never have your hedge against inflation for your shelter costs. You will have rents go up, they go down, whatever. In the long-term chart, rents are going up. And if you rent for the next 20 years, you'll, instead of $2,000, you'll be paying $4,000 in 20 years. Or you get your mortgage, you set it, your taxes, insurance go up this much, but you insulate yourself from that environment. So it's not just building equity, it's fixing your payment for if you never want to move and you stay in that home forever type of feeling. You build equity, you can trade up your home, sell your home, you made $100,000. Now you can throw that into the next home if you got a promotion or any which way. So absolutely. I mean, I think it's a crucial piece to the American dream. It's kind of tough to do it without it. But I think you are 100% right. When home prices have gone up so much and rates are still higher at the moment, people do have to pare back the dream home expectation. I'm a believer there is no such thing as a dream home. Every cycle in life, you're single, maybe you get married or don't, maybe you have kids or you don't, bigger home. All right, I got a promotion. I want my awesome home now. I got a lot of money. Wait, kids are out of college now. All right, well, I don't need this big home. Why am I paying all this? I'm going to downsize. It's just an evolution with life. So I think tempering expectations is important because you don't need to get your dream home. You don't have to get the most amazing thing your budget can afford. Get into a home that works for you and your family and that you like. And then most people will sell that home in 5 to 7 years and move on to something else. So I think tempering is important, but I think home ownership is crucial to the American dream and building wealth.
Yeah, go ahead, Chris.
I couldn't agree more. And I think you have to understand, you brought up Grant Cardone. I think you have to say, well, what is the audience that he's looking to talk to and attract? And it is an investor pool. And maybe for certain investors, that may make sense, but it's going to be a very small group of people. Without question, the wealth is created in real estate. There have been more millionaires that have been created through the vehicle of real estate than any other asset class, period, end of story. And when we're looking at the idea that, Zach actually explained this very well, is just the fixed payment, but also understanding that part of every payment is going towards your equity position in the home. It's like that forced savings account that is discussed from time to time. And if outside of it, unless you're going to live in mom's basement forever, you got to live somewhere. And so really understanding the area that you live in, what is your specific plan for this home? How long do you see yourself living in it is one question. How long do you see yourself owning it is a different question, because this could be the move up house, which you then start building your own real estate portfolio. It becomes a rental for your next springboard house, or sell and buy. And people just have all different needs. At the end of the day, what I find a lot of the questions are answered with when asked, like, what is your intention? What is your plan for this home? And then everything else starts to cascade from that question.
No, absolutely. So, so we have the general topic of equity, which I think is extremely important, right? For sure. But then we also have the topic, the burgeoning topic over the past few years of equality, right? And this is back in mid 2020. I had Richard Rothstein on the podcast, and he wrote a book, New York Times bestseller, called The Color of Law. And if you haven't, read that, let me know. And I have some copies here. I'm be more than happy to send it to you. And so, being a person of color, it's extremely important to me that there is an equality of sorts, but I don't believe in just kind of something being handed. I just don't believe in it at all. It's not how I was raised, and it's not how I was educated. It's not how I practice. But at the same time, there have been instances that have been highlighted across the country with regards to appraisal bias and with regards to lending bias, in particular with Wells Fargo. I did a podcast on it, just blasting them, and I wanted to get your thoughts, with regards to that, because yes, the percentages are small for sure, because if it was bigger, it'd be a 4-alarm fire, but the percentages are small, but it's still a problem. That's out there. And in particular with appraisal bias. And let me just share with you one quick thing, and then I'll have you start, and then Chris go. I had a deal 2 months ago where there was a guy buying a row house, completely renovated in Baltimore, Maryland, right? It wasn't necessarily in the best area, but when you see the pictures of the home on the inside, it was beautiful. The kitchen redone, hardwood floors, nice fixtures, beautiful, well done home. Well, because it was a fix and flip, right? And he was doing an FHA loan within a certain period of days, we had to have 2 appraisals done on the property because of the FHA guideline. The first appraisal came back at value, no problem. Well, we had to have a second appraiser go out there. The second appraiser went out to that property, met the seller. The seller happened to be a person of color. That seller shared with me that he felt unwelcomed by the appraiser. The appraiser asked him a lot of unusual questions that the first appraiser didn't ask. That appraisal came back $80,000 less and killed the deal. I mean, absolutely killed it. There was a lot of back and forth, a lot of issues, this and the other. And it just bothered me. And I'm like, this is real. This is real. Now, do we want to experience that a lot? No. But I want to get your thoughts on 2 things. Number one, with regards to appraisal bias and what can be done one way or the other. But number 2, with regards to, minorities or people of color and helping to educate so that there can be more of a parity and a level playing field with regards to having access to various loans and being able to take advantage of what everyone else in the country has been able to take advantage of. Zach, we'll go ahead and start with you.
Yeah. So for the scenario that you mentioned, I don't have the numbers up. I could try and get them real fast, but I've seen multiple articles on very similar things. It's one appraiser comes and, they don't meet the owner, and then another appraisal comes and they meet the person of color, and it is just magically a different valuation, which is kind of bananas. As far as how to solve appraisal bias, that is a fantastic question. I think we live in a weird appraisal world where there is an aging appraiser population. What's the average age of an appraiser? 55-ish or something in that ballpark.
Anton, can you look that up and just kind of give us a number? But go ahead.
We all see it on miscellaneous deals where color is not a thing, where, you may have had an appraisal a couple months ago and you get a different appraiser to come in and magically the values are different. And just in general, it's so subjective, to start with. And then you add when any sort of bias or racism comes into play, and I can see would only make the issues worse. How to solve it? I mean, the only things I could think of is there needs to be a stronger governing board, if that's at the state level, if that's at a national level, for those type of complaints to be had. I know we've had issues that aren't even racially biased, where this is just the worst report ever, appraiser won't call us, this deal's dead, and those type of more normal situations. And then you try and figure out how to either hold the appraiser accountable or find some way to push that up to some level of governance. And I'm sure there's better ways than I know of, but I think it has to come down to some sort of board and reprimand and actually reporting people to shed more light on this and making it known in the appraiser community that better have your eye on the ball, because this just happened over here. This happened over here. You need to make sure that you're not having that type of bias. What sort of numbers are here? Majority men.
So it's around 50 or
50, okay. Majority are white, right? 85% are white. Average age is 50. Majority male. I mean, that makes sense for appraisers I've seen in my home. Governing board being one sort of thought. Besides that, I really don't know what the new crop of appraisers is like. I mean, I always hear that it's an aging community. It's hard to get into. It takes a couple years of apprenticeship. So I have no idea what the new blood even looks like in that, because it's always that feel of the 50-some-year-old white man is your average appraiser.
Yeah, and I think there's more technology that's been out, but I think it's more prevalent with the AVM, the automated valuation models, and I think there has to be more, just generally, because I've had a handful of deals throughout the years, has nothing to do with appraisal bias, but just die because the appraiser appraised the house really low. That has happened with some VA loans, and the thing is, it's very hard to kind of rebut. I have very rarely seen where an appraiser will come back and significantly raise the value that he or she has assigned. Maybe you all have seen something different, but we can go to the listing agent, the buyer's agent, get some solid comps, things have just sold. And I think for some reason it might ding them or something like that with regards to their license if they change their values. But it doesn't put us on this side of the ball in a really good position, especially if a listing agent has done his or her due diligence to assign a value to a property based on their research, right? I think the only thing that's really the saving grace for a lot of appraisers is that it says opinion of value on there, and that's what they hang their hat on, for sure. But so, Chris, I'll let you go ahead and go.
Sure. I mean, and Brandon, you just mentioned it. There's this sort of evolution that is happening, and it's not just in the appraisal world, but it's certainly in our world too. Just this shift to a bit more of a computer model, to strip away some of these biases that do exist. I think that to answer this question, it's the age-old question of just why does it exist in the first place? Clearly history, we understand all of it, but it's more of what you would hope to see as the new crop of appraisers come in, that they have grown up in an environment and in a culture where that inclusiveness is much more of a commonplace thing, that it needs to go away. This treatment of people based off of, there's only so many laws that we can build surrounding these foundational truths, as far as I'm concerned. But in order to do it, I think that it's kind of going to be a little exclusive, quite honestly, to VA and FHA, because you have these appraisers that stick with the property for 6 months. You can always go back out and get a conventional and sort of challenge that. The thing that always blows my mind is when you are preparing and showing comps, like in that example that you gave, Brandon. What were the comps on the first one that weren't on the second?
Right.
And why couldn't they be used?
Right.
It would be just the most basic question that you could ask, and getting an answer on that shouldn't be that difficult. But as far as an overarching view, I'm thankful, just in my experience, I have not seen that. We have seen lower appraisals come in, and I've been successful in challenging a couple of them. I was a former realtor, so that, I was a realtor for 10 years before being a lender. And so I know how to look at the market, still have some access to certain things that I can certainly challenge. But at the same time, most of the appraisers, at least in my experience, have been relatively accurate. And as time has gone by, they actually reach out. Like when they're having difficulty coming up with a value, they're going to reach out and ask. This has been my experience over the last few years. VA, obviously, we have the Tidewater Act, and where they at least ask so that they don't come across. And I think that there is an attempt there to actually deal with the issue of bias that the VA is at least trying to address through that process. So it really comes down to FHA, which is kind of an interesting thing, that like, what are the checks and balances there? What is the recourse that you can take on clearly a biased appraisal? So I don't know if I have the answer to that, but I think that there are a number of things, and you hope that the evolution as this new crop of appraisers comes up, that it just becomes much less an issue. Those are my thoughts.
No, absolutely. And again, I think I think you both are right in terms of, I don't know if there's necessarily like this answer, right, to kind of make everything right. And it's unfortunately, we have to deal with certain social issues, but I am very grateful that it's such a very small percentage, right? Yeah. But it still exists, in everything. However, so some time back, every once in a while, I will go on a rant, and I went on a rant in terms of, you mentioned FHA and VA. There was a time where I think, especially 1920 last year, a lot of listing agents, when they would get multiple offers, assume same price, right? Same offer, but you have the conventional one in one hand and you got the VA and the FHA, and they were advising or steering or guiding their seller, right, toward conventional. And that bothers me so much. And I've done a couple of videos and rants on that, because it's a form of bias as far as I'm concerned, because you have no idea how strong this client is, right? How strong this buyer is, just because they're using FHA or okay, what makes the difference if the veteran is using his or her entitlement
Right.
to purchase a home, right, versus conventional? What makes it? The money is still green. The offer is still there. The closing date is the same, right? And if the loan officer has done his or her due diligence, it should not really fundamentally be different than a Fannie Freddie offer, as far as I'm concerned. And so I wanted to kind of get your thoughts, with regards to that. Have you experienced that? Have you seen it? And kind of, what can we do to really, flip the script and really educate the population on that? So I'll start with you, Zach, and we'll go over to Chris.
Definitely felt it for sure. My entire career. I started originating in 2006, and I do feel as though it is slightly less of a problem today than it was maybe 10 years ago, just anecdotally from my experience. To me, FHA is more about, is there peeling paint? Is the condition of the home? Because their appraisals are a little tougher, right? But noticeably calls from realtors on scared, almost terrified to take a VA loan. And again, anecdotally, I have felt that it is typically more seasoned, older realtors who maybe VA loans 20, 30, 40 years ago may not have been as smooth. The non-allowable expenses have kind of changed over time to what the veteran was and was not allowed to pay for, and that got revamped, 10 years ago or so.
Right.
A little looser. Today, I don't know about you guys, but what's it take? An extra couple days on a VA loan versus a conventional? You get a case number. Here, you got to have termite inspections. Maybe there's a couple days. But you're right. It could be the strongest buyer in the world, but just because that person is using an amazing loan product designed for people who serve our country, I've gotten into, not podcast rants, but I've got into conversations with realtors. I'm more than happy to call the Channel 12 News and let them know that your brokerage is not accepting offers for people who serve our country, because it can be a little ridiculous sometimes. In reality, I think it comes down to how well can we educate the realtor. And as long as you get that opportunity, right, and you get the call, and you could go through, absolutely not. I actually think the appraisal process is better because of Tidewater initiative. Appraiser calls you first before they put their stamp on value, and we know stamp on value, and it's kind of tough to change it. I like that better. I think the guidelines are extraordinarily flexible. So you probably won't have that DTI issue if you hit, 50.1%. You're probably fine with VA. So I try to sell it as maybe it's a day or two longer, but I think it's a better product, a more efficient process in many ways, not all. But I most definitely feel that for my career, and to really find the reason why, I really don't know. But when I talk to realtors, it seems like VA loans used to be so tough. They were so hard. There used to be so many problems. Whereas now things are so streamlined in most of our businesses, it's not the case. No,
I would agree. Yeah, and go ahead, Chris.
So I think too, VA historically has gotten a bad rap. The idea that the appraisal comes in low, but over the past couple of years, appraisals haven't really mattered very much. You better have the extra cash to bring the difference. But so where I think it typically falls is in the lender required repair, or the fear of the lender required repair that FHA and VA both have that a conventional doesn't. That if they truly remove the conventional the appraisal contingency on a conventional loan, you're still good. But on a VA or FHA, that appraiser could theoretically come in and say, well, seller, you still have to fix X, Y, and Z in order for financing to go through. And that would be really the only thing that I could think of, that in a market that we've seen that's been so competitive that the sellers can get whatever they wanted. Why would a seller add a hurdle that everything else being equal, they don't have to add? And that's the argument from the seller side that I could kind of understand, the what if on a lender required repair. But then at the end of the day, you start to share that hey, you have an opportunity to sell your home to a veteran who has served our country. And quite honestly, if there's a couple little things like that are popped up, wouldn't you want to sell your home in a high quality condition to the next borrower anyway? So But arguments certainly can be made for both. But I think that has been the real hang up, is the potential for risk and therefore an outlay of expenses to me as a seller that wouldn't otherwise exist in a convention.
No, and I agree. And I think you kind of hit on some important points, because that's from different realtors that I've talked to. The primary concern, right, has been about the lender required repairs, for sure. But for some reason, there have been realtors who've gotten in their mind that, they're going to use different comps. And I'm like, why would you think they would use different comps? There's no guideline. There's no, reason for that to be done. And I don't, I think that's part of it, but my opinion is just that the other part of it, they just, and I can understand this if I'm a listing agent, I want to be able to decrease the level of risk for my seller, right? That we're not going to go on time, or we're going to go to closing on time, because you contracts are not arbitrary, the dates. So I do want to level out that risk for my seller. But I think at the same time, I think that's important to educate a lot of the agents in terms of, okay, well, you could have someone who has a 740 FICO score and they can have a VA loan, an FHA loan, or a conventional loan. But there's a reason why they have an FHA loan. They didn't know that they had a bankruptcy Chapter 7 3 years ago, but you can't get, conventional, but you can get FHA, and you can have just as high of a FICO score, and your deal will go through very fast. Or Zach, as you said before, like I've had a guy do a VA loan who I know it's a bit technical, but he had a 49 front end ratio. Got an approved eligible. Great. Let's make it happen. Right. And I think it's our job to be able to, work with the buyers and put them in the best products possible. But real estate, regardless, is a relationship business. It's a relationship business. And so one of the things that we'll talk about as we end off is, what have you been doing and what will you continue to do or even improve upon with regards to your relationships with real estate professionals, whether it's realtors, title companies, or anyone in the space, as we go forward. So we'll start with you, Zach, and then we'll end with Chris.
I think it's a great question, because that's something we've been thinking about and working on, because kind of a question several ago on how many realtors are going to fall out this year. It's kind of interesting in just a wild market of 1,000 realtors getting their license a day, meeting new people, building those relationships, figuring out who you want to work with and who you want to spend your time and energy with. I love working with new realtors, because you get to build a relationship. You get to give some of the education and knowledge that I have to them, and they can give me their experiences back. But also, we only have so much time, and we have to figure out which relationships to nurture and work on the most. For me, in my business, realtors are vastly important. I want to focus on some new states now that COVID is mostly behind us, right? I want to do some more traveling to areas that, states we're licensed in, but maybe don't do a ton of business in. And other professionals as well. I think focusing on the financial advisor world is very important for our business. I think that's overlooked. A lot of loan officers focus on realtors, but I think financial advisors are a great partnership to where you can, again, someone at high knowledge level and someone who's done this for a lot of years, like you guys as well, can provide so much service to their clients. So yeah, 100%. It is a relationship business, and nurturing new ones and rekindling old ones that we haven't seen for years because of COVID and people working from home and all that type of stuff. No,
absolutely. And what do you think, Chris?
Well, the double down certainly has to happen, because I think there's a massive opportunity for all of us. And I've always been a very relationship driven individual. And that's where it gives me kind of the energy to go out and do what we do. I love working with people. I love working and making sure that their clients feel so cared for, that it just represented them so well, that they were actually so appreciative to be referred to me. That is kind of the goal, is if I have satisfied the expectation and have made that agent look great, then I've done my job. I've done that. The clients had a great experience, and it's just a byproduct of treating people well and helping them spend the extra time structuring financing to help them succeed, help them create wealth, help them achieve the goals that they've set out for themselves. So, so that's what I'm really looking forward to in the new year. I'm happy to see that, there's going to be a lot of LOs that are going to be getting out of the business, because I think that it's just increasing the pool for those that are really in it for the long haul. And I don't think the new year really changes much. It's always should be the focus of building a team that can then support us going out and doing our job, which, Zach, as you said, is just building relationships and really helping others succeed as well, helping that, being a resource to helping our agent partners grow their businesses as well. So.
No, absolutely. And I appreciate both of you with the, kind of ending thoughts, and definitely appreciated this conversation, today. I appreciate your perspectives and your experience and what you bring to the table in terms of helping people, because at the end of the day, that's what we're doing. And, I look at it as, the house is, I think one of you alluded to this earlier, but the house really is the end result. It's, that journey along the way to help them learn about the process of getting into the home. But once they're in the home, they're able to build new dreams, right? They need to have new experiences with their family. They may have a family member come live with them. If they're a young family, like you mentioned earlier, Zach, they can have children there, right? You have a headquarters, you have a place to have Thanksgiving and Christmas, or maybe you have a backyard, maybe someone wanted a garage. Maybe you don't want people living next to you. Maybe you don't care and you're in a townhome. Maybe, any number of things that helps people to build their dreams and build their life. That's kind of how I look at it. Especially being from Baltimore, being from an urban area, I want people to be able to aspire for more in their lives, period. And it's not going to be the same for everybody, but I definitely get that satisfaction. And, people are our testimony, right? At the end of the day, the people who've gotten their keys for the first time and they're smiling or they're crying and they're standing in front of the home. That's what we do, as being mortgage professionals. And so I really value and appreciate both of you. So thank you both for being on the podcast today, and continue doing what you're doing. At some point, we'll probably look more into Q2, going into Q3 next year. I'd love to have you both back on so that we can kind of look back on our conversation that we've had right now and see what, mid-year is holding for us, and kind of some of the things that we're working on and some of the things that we're changing. So thank you so much, guys.
Oh, thank you, Brandon. It was great to meet you, Zach, and look forward to doing it again.
Absolutely. It's been a pleasure. And it's real quick, Brandon, this may not make it, but if you guys have a couple minutes, I wanted to get your opinion on something.
Absolutely. No, please go.
Chris, are you good? Okay. So here's something I've been thinking about the past few months. And in my career, 2006, I started. Inflation's never really been a thing. It's never been a problem, right? Mm-hmm. Inflation's in line, a little high, a little low. Nothing big so that I've had to dig into what inflation reports are out there, CPI versus PCE, and all this stuff. So the past several months, I've been digging in more and more about inflation and how these actual reports come out. And I keep hearing with the CPI report specifically, right? There's the CPI and PCE are the two most important inflation reports.
Yeah. Can you explain exactly what they are for our listeners?
Yeah. And so CPI is the consumer, and let me look it up so I don't mess up.
Consumer Price Index.
Consumer Price Index, which is survey from the actual consumer on what's going on with prices. Food, energy are part of it. Those are the volatile components that are removed for core CPI, but it covers shelter, medical, education, a vast array of consumer expenses. And each month there's a new report that comes out, and they compare, like one just came out today, right this morning, and that was for November. That was November's CPI. So they'll do a month by month, but they do a running year tab, right? The past 12 months. And they do the same thing with PCE. And PCE is a little bit different because I believe the way that they get that information is less on consumer survey and more from the actual source. They will get some things on actual cost to produce certain goods. And both of them are important measurements of inflation for the consumer. What I've noticed is Chairman Powell seems to be talking and referencing CPI a lot more than PCE. If you Google it, it says, well, the Fed kind of looks at PCE a little bit more, but they're both very important. Just in the press conferences, like he's mentioning CPI all the time. So I started to dig into CPI and what the actual components are and what is this thing actually made of. And 32% of the CPI report is shelter cost. So about a third is shelter cost. It makes sense, right? That's a third of our expenses. Okay, that's a good start. But then you look at what that is actually made up of. Of that 32%, 8% is actual rents. I call Brandon's renting home, and this is the U.S. Bureau of Labor and Statistics, does these surveys. I call Brandon's renting. How much do you pay in rent? I pay $1,900 a month. Thank you. 8% of the entire CPI report is that, actual rents. Home prices are not part of it at all. The other 24%, so 24% of the entire CPI report, because we have 8 for rents and the other 24, which makes up the 32% of shelter. The other 24% is called owner equivalent rent, OER. I had to look this up, and I had to stare at it for days to try and understand OER. And when you Google the definition, it's very short.
Okay.
The U.S. Bureau of Labor and Statistics calls homeowners every month, random homeowners. You're not a property manager, a realtor, an expert, Bob, Jane, the random homeowner. If you were to move out of your home, how much would you rent your home for? I think I rent my home for like $2,500.
Interesting.
Okay. So the 24% of CPI is consumers' sentiment on what their home would rent for, not the value of their home, what their home would rent for. Very odd metric. I've seen a lot of case studies, and hey, they've been doing this for years, and there's a reason why. If you actually follow the OER, it does a pretty good job of following inflation and following shelter, but it's such an odd metric. But I think what's interesting about it is that most experts agree that it trails actual shelter costs. Home prices are coming down, and I'll try and Google it real fast. Actual rents are coming down month over month. Month over month nationally. I think last month it was like minus 0.2 or minus 0.1. But in the CPI report just today for November, I got it up over here, headline CPI for the month rose 0.1%. So if that was the trend for 12 months, that's 1.2% inflation on the year, which is below the Fed benchmark, right? You strip out food and energy because energy came down. Core CPI, less volatile, was 0.2%, which would be 2.4, right? Pretty close to the Fed target. Some pretty good numbers. But if you look at the report, 0.6% increase in shelter. People still are giving higher OER amounts on these rental surveys. And that is 0.25% of the CPI report. So shelter was 0.6% increase. Did home prices go up last month? No. Did rents go up last month? If we pull it up, at least last month, it was down ever so slightly. So how long does it take? 3 months, 6 months for the consumer, your average person on this survey, to answer the phone and be like, dang, rents are coming down. Home prices are down. We're in a recession. Oh, man, I could probably rent it for $2,300 instead of $2,600. The moment OER goes negative, which you would think it would with this massive correction in home pricing, it's a massive component of CPI. I have a theory, a thought, a possibility that we could be seeing negative month over month inflationary numbers, especially 3 to 6 months out when the consumer has enough time to digest that. But then if you also think about CPI as a trailing 12-month average, there's the month over month, and everyone talks about the yearly number, 7.1, everyone hangs their hat on that. Well, if we pull it up now, March and May, I want to say, of 2022 had massive month over month inflation numbers, right? Like 1.2, 1.6, somewhere around there, right? So when we get to Q2 next year and 1.2 falls off, 1.6 falls off, and if we do have a negative 0.2 or something negative, and this is just CPI, there's PCE too. But if we start seeing just inflation come crashing down because OER is caught up, and the Fed's obviously pumping the brakes on the economy, trying to stifle demand. So if that works for the rest of these goods, we could see a really drastic change in CPI numbers in about 6 months. And Chris, you mentioned this at the beginning. Mortgage rates really follow inflation because the Fed responds based off inflation. That's one of their mandates, right? A 2%-ish mark of inflation and employment. So if inflation starts coming down rapidly, we're digging into a recession. The Fed is going to, how fast they respond and ease, who knows. But if inflation starts coming down a little bit more rapidly than people think, mortgage rates start coming down a little bit more rapidly than people think, I think there's definitely a case that we're in the fours Q2, Q3. So that's something I've been just working out specifically on the OER, how big it is of that CPI number. It's 0.25% of the nation's CPI report, owner equivalent rent survey.
It'd be interesting to see what the responses were back when CPI did jump that high, what OER was reflecting in those reports.
Yeah,
March, April, May of last year.
The chart I have up just goes back 6 months, and it's amazingly steady. Shelter's been May 0.6, 0.6, 0.5, 0.7, 0.7, 0.8, 0.6. Steady as could be.
So it makes sense that it should have been pretty high based off of returns and what everyone's hearing on the news. Because, it's the consumer response has always lagged. No matter on interest rates, we talked about that. We've talked about, everything that if it's, they're hearing about it once, it's on mainstream media.
Over and over and over. Yeah.
And whenever you hear that, you're at best 2 weeks behind the curve. So, no, that's interesting. That's very interesting.
Yeah, because it sounds like when they're giving these responses, like you kind of mentioned this, Chris, it's a lagging indicator, right, of what's kind of going on. And so, is it truly representative of exactly what's going on, depending upon when the responses were given, versus a leading indicator, right? We know that the leading indicators that when these rates go down, we can predict with a certain level of certainty what's going to happen in a certain number of months with regards to the housing market. So I think that's pretty interesting, Zach, that you bring that up. And Chris, said the same thing.
And just to wrap a bow on it, if shelter costs in this past month were zero, if OER and shelter was zero, not even going down, we would have had a negative CPI report today.
Wow.
Shelter was zero, we would have had about -0.1 or -0.2 negative inflation. Mm-hmm. Which we actually probably need, right, to come back a little bit. But if it was zero, we'd have negative inflation today, and the markets would be just going
exploding. Yeah.
No, it would be insane. So, and I'm glad that so happy that you brought up those that data, because if we're not looking, the average person is not going to be looking at that, but it does give us a really good idea with being within the industry, right, with regards to the OER. The percentage that it does make up of the CPI. I'm going to look into that, for sure.
It's interesting. And I keep throwing it out there. I keep telling people that it's kind of a boring topic. So everyone's like, oh, okay, cool. But I think it could have some weight, and next year for sure.
Yep.
Interesting.
So good. So then we can put together a chart or check out, some stuff, as well. Yeah. So good. Well, I think that's a great way to end. I just want to thank you both, for sure, for being on here, for giving your expertise, giving your experience and opinions. And I look forward to having you both back on here again soon.
Absolutely. It's been a pleasure.
Great. Thank you, Zach. Thank you, Chris. All right, people. We had an amazing podcast today going over the mortgage industry, real estate industry, inflation, the economy, everything all packaged up for you as a great Christmas present coming up in a few days. Love you all. Take care of your families. Peace and take care.